Hi, good afternoon. Welcome to my webinar on China and Hong Kong stock market, our Q2 strategy and stock picks. As you are aware that the tariff war now is the most important factor and the most uncertain factor. So my webinar today will focus on the impact of the tariff war on China and the stock markets, China and Hong Kong stock markets, and also on individual stocks. We'll analyze the impact of the tariff war on individual sectors and individual stocks, and also shortlist the key winners and key losers under the tariff war. Okay, so let's start with this is the disclaimer. Okay, so before the breakout of the tariff wars in early April, actually, the Hong Kong market saw a very promising first quarter this year. The Hang Seng Index was up 15.25% in Q1, driven by euphoria over AI, triggered by DeepSeek. It was the Hong Kong market was the best performing major stock market index globally in the first quarter, as the Hang Seng Index rose to close to 25,000 in mid-March. But subsequently, because of the tariff war, especially China, US targeting China, we saw a sell-off recently, with the Hang Seng Index falling to below 20,000 briefly last week to a recent low of around 19,260. But subsequently, we saw the Hong Kong market managed to rebound quite strongly. Today, it was trading above 21,000. Okay. Hang Seng Tech Index was up 20.7% in Q1, and Alibaba among the tech stocks was up 55%, outperforming the tech index to a large extent, helped by AI and also euphoria towards DeepSeek. The Hang Seng Tech Index peaked at close to 6,200 in early March, and recently it fell to around 4,290. As you can see from this chart, the red line represents the 250-day moving average. So the Hang Seng Tech Index managed to hold above the 250-day moving average, and now it rebounded to around 5,000 points from recent low around 4,300. Okay, here I will give a very brief account of the US-China tariff war, the development since early February. Although it's a brief account, it took up 4 or 5 pages of my slides. You can see that there's a lot of development, a lot of news moving the market. On February 1st, Donald Trump initiated a new phase of trade tariffs by imposing trade war by imposing a 10% tariff on all Chinese imports that was started in early February. Then on the 4th of February, the US increased tariffs on Chinese imports to 20%, and China responded by announcing plans to levy retaliatory taxes on select US products. Those specifics were not immediately detailed. It was not until March 4th, 1 month later, that China announced retaliatory measures, countered with 15% tariffs on US agriculture products, not across the board, not all US imported goods, but only on US agricultural products. Then on April 2nd, Trump announced adding a 34% tariff on Chinese goods, bringing the total to 54%. So this started the tariff war. It escalated in early April. On April 4th, China unveiled a 34% tariff on all US imports. China responded tit-tat against the US. and alongside export controls on rare earth elements critical to high-tech industries. And Beijing also added 11 US companies to its unreliable entity list, restricting their business in China. So these are the retaliatory measures taken by China. Then on the April 9th, the US raised tariffs on Chinese goods by 50%, so bringing the total tariff rate to 104%, 20 plus 34 plus 50. Okay, Trump said he would soon announce major tariffs on imported pharmaceuticals. An hour later, China imposed an additional 50% tariff, bringing its total to 84% on all US goods. Trump then increased the rate to 125%. So this happened quite drastically between April 9th and April 10th. The tariff rate on China was increased to 125%. And China also targeted 18 US firms with sanctions. Okay. Sorry. On April 10th, White House officials confirmed the actual tariff rate on Chinese imports was actually more than 125%. It was actually 145%, factoring in a prior 20% tariff related to fentanyl. Okay, and on the 11th April, China's Ministry of Finance announced an increase in retaliatory tariffs on US goods from 84% to 125%, matching the US, except for the 20% tariff related to fentanyl, and stated that if the US continues to escalate tariffs, China will ignore further increases, noting that the current tariff levels have already rendered US goods uncompetitive in China. So there's one signal that China will not retaliate in the area of tariff rate, even if the US continue to raise tariffs on China. And on the same day, the US Customs and Border Protection issued a notice exempting 20 categories of electronic products from reciprocal tariffs, effectively retroactively from April 5th. Yet, it was reported that the Trump administration is moving toward potentially delisting Chinese stocks from US exchanges. I will elaborate later on the impact on Hong Kong, because it may be seen as a beneficiary to potential delisting of Chinese stocks from US exchanges. And on the 13th of April, Trump warned exemptions on electronics will be short-lived and tariffs for imported semiconductor chips will be coming soon. Okay, this is the latest development. Okay, impact on China. Mainly, there are five areas. We shortlisted five areas that will have an impact on China, namely export decline, GDP growth slowdown, job losses, inflation, and renminbi depreciation. Okay. China's exports to the US valued at over 500 billion US dollar annually are a key economic driver for China. In 2018-2019, when during Trump's first presidency, US tariffs of 19% reduced Chinese exports to the US by 200 billion US dollar annually. So now with more than 100% tariff rate, the impact would be more significant. A 125% tariff rate could reduce export volumes by 50% or more, potentially costing China 300 to 400 billion US dollar yearly. Chinese exporters with production in Vietnam and Cambodia are also significantly affected, as these Southeast Asian nations have been key destinations for Chinese firms relocating manufacturing to circumvent earlier US tariffs on China. So the Trump administration, to many people's surprise, announced tariff rate of 46% on Vietnam and 49% on Cambodia. It is analyzed that actually is directed against China, Chinese exporters with production in Vietnam and Cambodia. Okay, so China has shifted exports to Southeast Asia, Europe, and Belt and Road countries, but these markets cannot fully replace US demand due to lower purchasing power and also lower prices, and which means lower profitability for Chinese exporters. Okay. Exports historically contribute around 20% to China's GDP. So a sharp export drop could shave 1 to 2 percentage points off China's annual GDP growth, pushing it below the 5% target for 2025. Currently, many iBanks have lowered their the forecast for China's GDP growth this year to between 2.5% to 3%, depending how the tariff war develops and ultimately, the outcome. Multiplier effect, because reduced export revenue will ripples through manufacturing, logistics, and labor markets, amplifying the slowdown. So it will have rippling effect on the China's economy. Okay. Job losses. Industries like electronics, textiles, and machinery, which are key US export categories, face production cuts. In 2018 to 2019, it should be 2018 to 2019, around 2 million jobs were affected. So 2025's much higher tariffs could double this, causing 4 to 5 million job losses, especially in coastal export hubs like Guangdong. Low-rent manufacturing, a backbone of China's export sector, is particularly vulnerable, risking job losses and factory closures. Accelerating factory shifts to other countries will also cause further job losses, eroding China's manufacturing base in the long term. And job losses could fuel discontent. In 2019, localized protests emerged in export zones. So the job losses this year and the scale risk, border unrest, broader unrest, and social instability that we have to be watchful. Okay. Another impact on China will be inflation. So China's tariffs on US goods raise costs for American imported goods, example soybeans and semiconductors, pushing up domestic prices. In 2019, soybean prices rose 30% due to tariffs. So a broader 84% rate could spike inflation by 1 to 2% in China. High costs for goods will pass on to consumers, pressurizing household spending amid already slowing wage growth. Okay. Another potential impact on China will be renminbi depreciation. The yuan will face depreciation pressure as export earnings fall and capital outflows rise. In August 2019, the yuan weakened past 7 to the US dollar after 7 yuan to the US dollar after tariff hikes. In 2025, it could slide toward 7.8 or beyond, prompting People's Bank of China intervention that may drain its reserves. It's already down from 3.2 trillion US dollars in 2018 to currently around 3 trillion US dollars. So now the renminbi central parity rate stood at 7.2 to 1 US dollar, and the offshore rate already depreciated to 7.4. Okay, so if the tariff war continues, the yuan will face depreciation pressure, and it's likely that it may slide towards 7.8 or even beyond against the US dollar. A weaker yuan may offset some export losses, but risk inflation, and debt serving costs. China holds around $1 trillion US dollars in US dollar denominated debt. So companies with higher US dollar debts will suffer because of the weaker yuan. So this is one thing to watch. Okay, the key losers will include companies which have US exposure, which have significant US sales or client base, such as Lenovo, Li and Feng, Tektronic. Okay, and companies that rely on US-China trade flows will also be disrupted by high costs and lower volumes, such as shipping stocks like OOIL and Costco shipping. And supply chain risk, companies that rely on Chinese components despite limited US sales, such as Xiaomi, may also be among the losers. And then banks, the impact on banks. Banks with trade financing, more exposure to trade financing and mainland China loans may face rising defaults and reduced activity as trade volumes shrink. So these are the potential key losers under the tariff war. And what about the key winners? Domestic focus, minimal US exposure and beneficiary of China's dual circulation strategies such as Tencent, Mengniu, Qingdao Brewery, CR Beverage, the basic consumption the stocks, the staple stocks will benefit. And then those with safe haven appeal may also do well, such as utilities that benefit from risk-off sentiment, such as Hong Kong and China Gas, PCCW, and China Mobile. Okay, and companies with growth resilience may also attract fund inflow, such as strong fundamentals and policy tailwinds, such as the EV manufacturers, Leap Motor and Xpeng, Xiaopeng. Okay, healthcare and pharmaceuticals may also be among the potential winners because they are less tied to trade cycles, and China's push for self-reliance may also boost local pharma, such as CSPC Pharmaceutical 1093, the stock code, and Sino Biopharmaceutical, stock code 1177. Okay. Gold and precious metal will also benefit, as you may notice. Gold prices have rose to new record highs, close to 3,450 US dollar per ounce. Tariff and recession fears may drive gold prices higher, benefiting miners and related stocks such as Zhaojin Mining 1818 and China Gold International 2099. So these stock codes, you may note down. The winners are stocks that you may consider, stock picks that you may consider, and those losers are stocks that one should avoid in the near term before the tariff war becomes more certain. Okay, U.S. pharmaceutical tariffs to be announced soon. Chinese pharma exports to the U.S. only accounting about 6 to 8 billion US dollar, are small compared to China's domestic market, more than 2 billion US dollar market size, suggesting there will be limited direct revenue impact on Chinese pharmaceutical companies because Chinese pharma exports to the US are small. Okay, but China is a major supplier of active pharmaceutical ingredients, abbreviated API, raw materials and intermediates. China is a major supplier of API in the ingredients and also intermediate to the US, accounting for around 70% of US generic drug inputs alongside India. So US buy a lot of API from China to be manufactured, to be produced into their generic drugs, okay, or innovative drugs. US pharmaceutical imports reached $213 billion in 2024, with China playing a critical role in low-cost APIs and generics. With slim margins, these are very low margin products, and it's estimated that every 10% tariff rate will hit profit by 2 to 3%. So the slim margins from generic drugs, APIs, tariffs could force price hikes or market exit by some pharmaceutical company. Tariffs on APIs could also force Chinese firms to seek alternative markets such as Europe, Southeast Asia, Belt and Road markets, but those markets are with lower profitability due to competition. Firms with US exposure, such as WuXi Biologics, Yaoming Shengwu, stock code 2269, face high risk due to reliance on contract research. It's CRO, Contract Research Organization, CDMO, Contract Development and Manufacturing Organization for US clients. More than 50% of its revenue are generated from North America. So WuXi Biologics is vulnerable to potential US pharmaceutical tariffs. Okay. US potential delisting of Chinese stocks. It is believed that it may make Hong Kong great again instead of make the America great again. The US potential delisting may make Hong Kong great again. I mean, referring to the Hong Kong IPO market. As of April 2025, there are 286 Chinese companies being listed on US exchanges, including NYSE, NASDAQ, and NYSE American, with a combined market capitalization of $1.1 trillion. Delisting reduces access to US market liquidity, forcing sales at depressed prices. So this is a near-term impact on those companies that are already listed on the US exchange. They may see their forced sales and pressurizing their share prices. But Hong Kong could benefit as the listing could redirect IPOs to Hong Kong EX, enhancing its $4.3 trillion US dollar market. Okay. Shanghai and Shenzhen could also benefit by forcing capital repatriation. Companies repatriate capital to China. But for ETFs holding those delisting risk firms, they are holding around like MSCI, China index, holding around 1.6% in delisting risk firms. It may drop 5 to 10% on mass delistings if it happens. Okay. Sidetrack a bit. Hong Kong IPO market did quite well so far this year. So up to in the first quarter, more than 40 billion Hong Kong dollar are being raised through IPO, and now the market expecting 70 to 80 IPOs in 2025 in Hong Kong, raising 130 to 160 billion Hong Kong dollars. Significant increase from the 69 IPO in 2024, raising only 87.6 billion Hong Kong dollars last year. Okay. So some forecasts suggest Hong Kong could reclaim a top 3 global IPO ranking if large Asia listing materialize. That will benefit the Hong Kong EX, of course. And one of the major IPO that the market are closely watching will be CATL, which has already passed the hearing, IPO hearing, the listing hearing of the listing committee, and it is expected to be listed in Hong Kong as early as end of this month or early May. So this is one of the major IPOs upcoming. CATL, the lithium battery manufacturer. Okay, China's potential bailout strategies. In face of the tariff war, China is expected to roll out more fiscal stimulus and subsidies targeting export sectors to help the export sectors, and also accelerate infrastructure spending and incentivize household consumption via tax cuts, vouchers, and lending. I think this time around, in the past, it was more through subsidies, by providing subsidies to consumers buying cars, electronic products. But this time around, they will provide incentives such as tax cuts, vouchers, and also lending, low interest rate consumer lending to induce consumers to consume. Okay. We also expect the PBOC, People's Bank of China, to cut rates by 50 to 100 basis points from around 3.1% policy rate now, and also reduce the reserve requirement ratio by 0.5 to 1 percentage points. Now it's around 6.6%. The RRR, the reserve requirement ratio. So we believe there's still room for the PBOC to reduce both interest rates as well as the reserve requirement ratio, and also will allow a controlled yuan depreciation to cheapen exports. Okay, and we may also see policy initiatives to subsidize exporters to pivot to other countries such as the EU, ASEAN, and Global South markets in trade credits, by providing trade credits to exporters to encourage them to move to other markets. Okay, the Hong Kong market, as I showed earlier, you can see the Hang Seng Index rebounded quite strongly after hitting a recent low around 19,260, and now it was trading at 21,000. Part of the reasons may be attributed to national team support, national team deployment to support capital markets. By national team, the term refers to state-backed entities such as Central Huijin Investment, China Securities Finance Corporation, Sovereign Wealth Funds, China Investment Corporation, and state-owned enterprises. Equity market stabilization through direct stock purchases and ETF support and SOE buybacks. So the national team is supporting the equities market by way of direct stock purchases or buying ETFs, and some of the SOEs are actively doing buyback of their own shares. Okay, and the People's Bank of China will pledge to provide liquidity to the national team. Okay, to support the stock market, and the CSF, which stands for China Securities Finance Corporation, will provide lending to securities firms to prevent forced liquidation of shares. Okay, this is also another another means to support the stock market. And debt market support through bond purchases to cap yields and ensure refinancing for indebted firms. Okay, so the national team support both the stock market, equities market, as well as the debt market. Short selling are being curbed, and IPO are being deferred to ensure that the capital markets remain stable. Okay, impact of the tariff war on individual stocks. Here we shortlist a few popular stocks that you may be interested in. The ATM XLA plus Alibaba plus BYD. Okay, Alibaba its international commerce will be affected by the US-China tariff war. AliExpress, targeting US and global consumers, may face a sharp decline by 50 to 70% in its US revenue, estimated 5 to 10 billion US dollars annually. But its domestic business comprises of Taobao and Tmall, which focus on China's market, are less directly affected. But the worry is a slowing economy and also inflation rising inflation may squeeze consumer spending, potentially also trimming domestic sales growth from 5 to 7% to the growth rate may decelerate from 5 to 7% to 2 to 4%. So for Alibaba, both its domestic business as well as international commerce will potentially be affected by this tariff war. As for cloud computing, it should revenue growth may slow from 20% to 10 to 15% because it's competing with AWS and Azure, risk losing US clients. Okay. Margins, in terms of margins, higher logistic costs for Cainiao and supplier price hikes may cut net margins from around 20% to 15 to 17%. This is the estimated margins, operating margins for its logistic business. So we reckon that the tariff war will have more profound impact on Alibaba because of its business exposure to the US in e-commerce as well as cloud computing. Okay, revenue loss. We have done an estimation, 3 to 8 billion US dollar annually, equivalent to 5 to 10% of its 130 billion US dollar revenue in 2024. So not too much, only 5 to accounting of 5 to 10% of its total revenue in 2024, mostly from AliExpress and cloud. Profit may see a profit drop. Net income estimated to be around 20 billion US dollars may fall 10 to 15%, reflecting margin squeeze and US market shrinkage. But there are some positive drivers for Alibaba. For instance, China has announced the launch of 500 billion US dollar stimulus package, may boost domestic e-commerce, and Alibaba may also stand to benefit. Okay, domestic cloud adoption may increase because driven by China's self-reliance push, and there may be more positive Qwen news. Its AI model developed by Alibaba. Example, more enterprise adoption of Qwen. Okay, I'm not sure if you're aware that Apple actually collaborated with Alibaba in AI using Qwen for its Apple Intelligence. Okay, and Ant Group's potential relisting may also be a potential positive driver for Alibaba. Okay, here I would like to talk a bit more about Qwen, its AI model. Qwen is developed by Alibaba Cloud. It's a family of large language model that's become a cornerstone of Alibaba's AI strategy. Its capabilities spanning natural language processing, text generation, image and audio analysis, and even coding have enabled Alibaba to enhance user experiences like smarter product recommendations and customer service chatbots on platforms like Taobao and Tmall. So it enhanced not only user experience, by enhancing user experience, it will also strengthen Alibaba's domestic e-commerce business. Its open source models, downloaded over 40 million times, have fostered a global developer community, boosting Alibaba's influence in the AI race. Its enterprise adoption with over 90,000 deployments has strengthened Alibaba Cloud's position as a go-to provider for AI-driven business tools, from data analytics to automated workflows. Quen is expected to boost future cloud revenue of Alibaba by 12% in 2025, by 20% in 2026, and 22% in 2027. So Quen will be one of the major growth engine for its cloud business in the next 3 years. Okay, this is the price chart of Alibaba. It peaked at close to 146 Hong Kong dollars in early March, and then it fell to below $100 briefly after in last week, and now rebounded to around 105 Hong Kong dollars. So the near-term resistance will be around $112, which is it is technically speaking is not the momentum is still not very strong, as it fails to fill the downside, the down gap seen last Monday. Okay, so the resistance, the initial resistance will be around 112 Hong Kong dollars, and key resistance is expected to be around 125. Okay, near-term support is $100, and key support is $90, seen which is around the 250-day moving average. The 250-day moving average now lies at $90. So if you are upbeat on Alibaba, you are recommended to buy in tranches. The first entry price would be around $100, and the next entry level would be 90 Hong Kong dollars. Okay. Tencent will be less affected by the tariff war compared to Alibaba, because its core business, comprising social platforms WeChat, gaming, fintech, and cloud services, are largely digital and less exposed to physical goods tariffs compared to e-commerce firms like Alibaba. Its revenue streams, such as in-app purchases or advertising, face minimal direct disruption. However, its gaming division do have ties with the US. I will talk about that later. But its gaming division is bolstered by upcoming releases of new games, such as Dungeon and Fighter Mobile, the mobile version of Dungeon and Fighter game. Its fintech and cloud segments continue to grow with AI investment. It has its own model, like Alibaba. Its AI model is known as 混元 in Chinese, 混元, enhancing advertising efficiency will also help its business. But broader economic slowdown in China due to tariffs could reduce consumer spending on discretionary services like gaming, which accounts for a significant portion of its annual earnings. So investors need to be careful about if there's a broader economic slowdown in China, then it may also impact its gaming business, and also its advertising business may also be affected. Okay, earlier it has been named in a U.S. military list. It was blacklisted by the U.S. military, saying that it's tied to the Chinese military. This may add uncertainty to Tencent's US exposed segments like gaming. It has investment in Epic Games and Activision Blizzard. Only this part may be affected. Other business are less directly affected by the tariff war. So the share price performance, it peaked at 547 Hong Kong dollars in early March. rising from around 365 very rapidly, driven by DeepSeek, the DeepSeek impetus. Then it corrected to, but it still managed to hold about $400 in the recent sell-off. Okay, so we expect near-term support at $430, and key support is expected around 405 Hong Kong dollars, where the 250-day moving average lies. Okay, near-term resistance is expected around 663, which is also the where the down gap last Monday lies. Okay, so far it's still not able to refill this gap yet, and the key resistance will be 500 Hong Kong dollars. Okay, 500 Hong Kong dollars. Meituan's operations are primarily domestic and less exposed to direct tariff impacts. Its entrenched platform with over 70 billion annual active users provide a buffer. However, a broader economic slowdown in China due to tariffs may potentially tighten household budgets, while Meituan benefits from value for money offerings, example, group buying deals. It has launched so-called Pinduoduo model in food delivery. 拼好饭 is like Groupon, group buying, group ordering meals to save costs, save money for its users. But a weak economy might push Meituan to offer deeper discounts, squeezing margins. Its operating margin was 13.4% in 2024. So it's afraid that it may be under its operating margin may be under pressure due to more competition, as now Douyin and JD.com, Jingdong, they both of them have entered the food delivery arena, competing with Meituan. And Meituan today, the founder said in the next few years, they are going to spend 300 billion yuan to as subsidy to support the merchants on their platform. Okay, so this will also affect the profit margin of the company. And the US blacklist of Chinese tech firms like Tencent in January 2025, which I mentioned just now, could limit Meituan's ability to expand overseas, forcing it to focus on China's domestic market, where growth is steady but kept by saturation. I would describe China's food delivery market as red ocean. Now it has become red ocean, very competitive with Alibaba's Ele.me and also new entrants such as Douyin and JD.com. So Meituan is already expanding overseas. He has come to Hong Kong under the brand Kita, and he has also expanded to Middle East. But further expansion, overseas expansion, may potentially be affected if is listed on some of the US blacklists. This is a potential risk. So its share price, you can see, is relatively more resilient. It fell from a recent high of around $190 to recent low around 130. So the drop was less drastic compared to Alibaba or especially Alibaba. Okay, near-term resistance is expected around 152, and key resistance is expected to be around 165, where above the 50-day and 100-day moving average currently lying at between 160 and 162 Hong Kong dollars. Near-term support is 132, and key support is expected to be around 120 Hong Kong dollars. So if you like Meituan, one recommended entry level would be 132, and the other Below that would be $120. Okay, Xiaomi, focusing on markets like China, India, and Europe, has negligible direct sales in the US. The trade war could indirectly benefit Xiaomi in non-US markets as tariff raise costs for competitors like Apple. While Xiaomi's supply chain, largely based in China and Southeast Asia, is less US dependent, US restrictions on advanced semiconductors and China's export controls on rare earths could increase prices for chips and materials used in smartphones, its IoT devices, and EVs, electric vehicles. So this is indirect impact that may have and may affect Xiaomi. Okay, Xiaomi's growth depends on strong demand in China and in also other emerging markets. The tariff war's economic fallout could weaken consumer spending. However, its affordable pricing strategy could help it capture price-sensitive consumers. So we expect Xiaomi to remain competitive, even if consumer spending weakened because of the tariff wars. Potential U.S. sanctions. In 221, Xiaomi was also included in a U.S. military blacklist, but subsequently it appealed to the courts in the U.S. and subsequently was removed from the blacklist. But whether the U.S. will again sanction Xiaomi for the same reason or other reasons, there's this potential risk. It may hinder its expansion internationally. So for Xiaomi, we expect the domestic business will not see any direct impact from the tariff war, but its international expansion may see potential risk from U.S. sanctions. Okay, recently because it saw accident of his SU7 vehicle, so he has deferred the launch of his new EV YU7, okay, until further announcement. And also the 15 Pro smartphone and other new products supposedly to be announced this Thursday has been deferred. Okay, and the investor day, which is supposed to be held this month, is also postponed to June. So this is maybe the short-term headwind for Xiaomi following the accident from its SU7 vehicle. Okay. Xiaomi near-term resistance, we expect near-term resistance around $48, around its 50-day moving average, the blue line, and key resistance is expected to be around 54 Hong Kong dollars. Okay, near-term support 40 Hong Kong dollars, where the 100-day moving average lies, and key support is expected to be around 36 Hong Kong dollars. For Xiaomi, recently before the market sell-off triggered by the US tariff wars, it has successfully conducted a share placement in Hong Kong, raising more than 40 billion Hong Kong dollars. Okay, so that will strengthen its financial position and also strengthen its capability for new EV development in the coming 2-3 years. It will be able to meet the capex demand for its EV as well as smartphones development. Okay, for SMIC, SMIC chips are mostly sold domestically. 86.6% of revenue from Chinese clients in third quarter 2024. Sorry, there's a typo error here. It should be 2024 or to non-US markets. It faces minimal direct tariff impact because of its small low exposure to the US. Domestic demand for SMIC's chips, especially for Huawei and other local tech firms, has surged as US sanctions cut off Western alternatives. Actually, it benefit seeing more domestic demand for its products. The trade war has accelerated China's drive for semiconductor independence, also benefiting SMIC through government support. Is receiving more support from the government because China is pushing self-reliance. Tariffs on semiconductor manufacturing equipment or components could indirectly raise costs as SMIC relies on global supply chains. And SMIC lags behind global leaders like TSMC and Samsung in advanced chip production due to restricted access to extreme ultraviolet EUV machines. Restrictions on US allies like the Netherlands could disrupt its equipment upgrades. So this is one of the potential risks SMIC is facing. Okay, near-term resistance is expected to be around 49 Hong Kong dollars, where the 50-day moving average lies, and key resistance is expected to be around 53. Actually, its share price is quite similar, the pattern similar to Xiaomi, both peaking around close to 60 Hong Kong dollars and dropped to below 40 Hong Kong dollars and subsequently rebounded. But SMIC seems to be more, the rebound seems to be more powerful compared to Xiaomi. Xiaomi, I think in the short term is impacted by the accident, over SU7 in the short term. Okay, near-term support is expected to be around 43 and 37 Hong Kong dollars. Okay. BYD has also minimal direct sales in the US passenger EV market because during Biden's presidency, the US has already announced 100% tariff rate on Chinese cars. So literally, no Chinese cars are imported to the US because of the very high, the 100% tariff rate. So BYD actually is focusing on China. Over 60% of its 4.27 million vehicle sales in 2024 are sold domestically, and also other markets like Europe, Southeast Asia, and Latin America. Its commercial vehicles like electric buses and trucks sold in the US will face higher costs. Though this segment is a very small fraction of its business, accounting for less than 5% of revenue. Okay, as BYD relies on global suppliers for certain EV components, such as semiconductors and rare earths, tariffs and US export controls indirectly raise costs for its supply chain. So this is negative to BYD. However, BYD's vertically integrated model, it produces its own batteries and chips. The Razer battery could mitigate part of the rising costs. US tariff hikes have prompted the EU to consider raising duties on Chinese EVs. EU tariffs reached 45% in October 2024. This threatened BYD's European sales, which grew 300% last year to 200,000 units. To counter this, BYD is localizing production, but building overseas facilities may drain its capital. For instance, in 2024 alone, it has committed $2 billion for building overseas facilities. Okay. China's economic slowdown worsened by tariffs could soften domestic EV demand. So this will be the indirect impact of the tariff war on BYD. However, BYD benefits from government subsidies and consumer preference for affordable EVs. We believe that going forward, China will still support the automobile industry by providing subsidies or other forms of support. So this will benefit BYD going forward. US and EU duties on Chinese lithium-ion batteries, respectively 25% and 17%, could limit export growth of BYD's battery business. Okay. BYD, the near-term resistance is expected to be around 385 Hong Kong dollars, where the 20-day moving average lies. Key resistance is expected to be around 415. Okay, near-term support is expected to be around 340 Hong Kong dollars, about here. And then key support is 310, where the 100-day moving average, close to the 100-day moving average. So this ends my presentation today. We'll share with you our expected US tariff war impact on China as the economy as a whole, as well as on the stock market and the different sectors and individual stocks. As for the Hang Seng Index, we have certain resistance levels for you for your reference. Okay, the Hang Seng Index, just now I mentioned, if it the first rebound target will be around 21,580, which it has reached this morning. It rose to above around 21,600. Our analysis is based on the we expect the index to fill the last Monday's downside gap, which is 1,590 points wide, lying between 22,638 and 21,048 points, and a half gap fill would take the index to 21,840. So our next target, rebound target will be 21,840. Besides gap analysis, Fibonacci retracement can also predict rebound targets. The recent decline from the March 19 high of 24,874 to 19,260 was 5,614 points. So a 38.2% retracement will give a target of 21,400. I'm referring to Hang Seng Index now, which was already achieved yesterday. A 50% or 61.8% retracement would target 22,070 points and 22,730 respectively. So the chance of rebounding to between 21,800 and 22,000 is higher, and based on the current US-China tariff war situation and further uncertainty, we expect the chance of rebounding to above 22,000 at the moment is rather slim at the moment. Okay, so let's see what questions you have from the audience. Before I do Q&A, I also would like to draw your attention to our YouTube video. This month we launched English version of our market opening bell. You can see this is our video today. Maybe you can show it a bit. You can switch. Yeah. Okay. Hello everyone, welcome to the market opening bell on Tuesday, April 15th. The Trump administration has excluded smartphones, computers, and other electronic products from typical tariffs for way to clarify the business effort. Semiconductors, smartphones, computers, and electronic products to pay separate tariffs. Hong Kong stocks rose on Monday's global market. The Hang Seng Index opened 9 points higher, peaked at 21,570, with a 602.8, and closed up 500 points to 21,470. Markets get 6% this day off again, and 2 Okay, we can stop here. So just give you a glimpse, view of our daily market opening bell video. So we'll provide the latest market wrap up and also our technical analysis and also trade data, the economic data, latest economic data, also company news and the points to be watch closely for the day. So if you are interested in our video, you may search it on YouTube or subscribe our Hong Kong Phillip Securities Hong Kong channel. If you search on the YouTube, you can type Phillip Hong Kong market opening bell video and you'll find it. Besides the English version, there is also a Chinese 普通话 version. Okay, we can show a bit to you. If you can understand 普通话 or like to listen to 普通话 better, yeah, you can also watch this video. Okay, we can stop here because in the past when I did seminar or webinar in Singapore, I'm always asked where they can find more market information or market news on the Hong Kong market. So I think this daily market opening bell videos may help provide more information, most updated information on the Hong Kong market to foreign investors. Okay, let's see what questions there are from the audience. On media, okay, there is impact on media because it's home appliance part of its home appliance is also exported to the US. But compared to its two competitors, Hisense and Haier, the percentage of exports to the US is the lowest for media. So it, we view that there is impact on media group. Yet the impact compared to Hisense 921 stock code and higher 6690 is less significant on media group. Okay. On the other hand, it will stand to benefit from subsidies and incentives to Chinese consumers to buy home appliances and electronic products. This is one of the tailwinds for media group, and also different from Hisense and higher media group is also developing robots that would be seen as one of the future growth driver, one of the future growth engine for media. Maybe you can show media group's share price here. Is it good? Yeah. Uh, you can see that it was also the share price also fell on last Monday because of the tariff war, but the rebound was quite strong. I will show you the other two stocks. They are also engaged in uh, home appliance manufacturing and also export to the quite similar the price pattern, but we think that the rebound was less strong compared to media. Okay, and the other one is 6690. This one among the three, the percentage of U.S. exports, the highest is higher 6690. Therefore, it's also reflected in the share price. Okay, next question. Has the Chinese government been selling U.S. Treasury recently? Do you expect the government to continue buying gold, and what's their target holding? It was speculated or also rumored that the Chinese government was selling some U.S. treasuries, but actually its impact on the bond prices of U.S. treasuries would be quite minimal. It's over exaggerated. The impact on the U.S. treasury market is exaggerated because it only accounts for China now holds about 700 billion US dollar worth of US treasuries, which accounts for only 2.2% of all outstanding US treasuries public debts. Okay, so even one view is that even if China sells all its dispose of all its US treasuries holding, will not deal a very severe blow to the US Treasury market because it only accounts for 2.2% of the US Treasury market. But foreign investors, including foreign central banks, foreign countries, central banks of foreign countries, in total hold about 22% of all US treasuries, US debts. So if other countries, say for instance, Japan is the largest investor with more than 1 trillion US dollar worth of US treasuries holding. And the second biggest investors is Canada, also holding around 700 billion US dollar worth of US treasuries. So if other countries jointly sell, dispose of, or reduce their U.S. Treasury holdings, then we may see an impact on the U.S. Treasury market. U.S. Treasury, you may see yields surging, and bond prices falling. Okay, and this will also affect the U.S. dollar. You may notice that the U.S. dollar index has recently fallen below 100 for quite a long period. It's been holding about 100, so it may signal some selling of U.S. dollars as well as U.S. treasuries, not only from China but also from other central banks or other foreign investors, because of their concern about the U.S. economic outlook impacted by the tariff war. Okay, yes, I do expect the Chinese government to continue buying gold. I don't think they have they will disclose the target holding, but now it accounts for, I think, between 5 to 7% of their reserves. Okay, I think we are not surprised to see that ultimately they will raise the percentage, the ratio, to around 10% of the reserve to be gold holding. Okay. Banks and insurance companies, we are more upbeat about banks rather than insurance companies, because banks, they are expected, they will be supported by, recently the People's Bank of China has injected capital into a few state-owned banks, including CCB and China Bank, Bank of China, to strengthen their capital adequacy. So Chinese banks will, especially state-owned banks, will receive support from the central government, and also in turn they will support the economy. Okay, and interest rate, we don't expect sharp decline in interest rate, because if the PBOC cut interest rate too drastically, it will pressurize the renminbi. So I think the PBOC will only cut interest rate more slowly and moderately. Okay, and this will also be in favor to Chinese banks in terms of their interest difference, the interest margin. Okay, but for insurance company, their earnings rely very much on investment return, especially from equities, investment in equities. Last year, if you notice that China Life net profit double compared to 2023, mainly because of investment return, better investment return from the stock market. Because last year, in the fourth quarter, the policy, two factors that caused the both the Shenzhen and Shanghai market as well as Hong Kong market to soar in the fourth quarter last year and in the first quarter this year. Last quarter is driven by the economic stimulus, the policy initiatives announced by Beijing to support the economy. And first quarter this year, it was supported and by DeepSeek and AI, the investment themes. So, but this year we expect a more volatile stock market and also a more subdued stock market, which we expect the investment return of insurance companies will be dampened. Will not see as good financial results as we did last year for insurance company. Among the insurance company, there's only one we favor, and that is PICC 2328. You can see in the chart that it outperformed other life insurance companies. It peaked at 15.2 Hong Kong dollars in early April, and now it's trading around 14. Now it's around $14, less than 10% down from the recent peak. But for Ping An, you can see that it has dropped quite a lot from its peak around 52 Hong Kong dollars in early March. Yeah, and then China Life also underperformed. Yeah, you can see that its share price dropped from $17.1 to 12.38, and now it's still trading below 14 Hong Kong dollars. So for insurance company, our topic is 2328. 2328. PICC. Gemini says the foreign reserve does not include gold reserve. Is that correct? It should be categorized in the central bank's reserve. Central bank's reserve. This one I'm not sure. I need to check out before I can give a firm answer on whether gold reserve is included in foreign reserve. Okay. I dialed in late and we have missed your explanation. Can you elaborate on why Xiaomi is a potential loser? Because of the supply chain. Its supply chain is exposed to different, say for instance, semiconductors, chips. It may have to source from the US, especially its high-end smartphone models, whereby domestic suppliers such as SMIC may not meet its demand on the high-end smartphones. Okay, what are your thoughts on China's stimulus and the real estate stocks being a potential beneficiary? The bailout, I have shared with you our expected bailout policies to be launched by China in the near term. But real estate stocks, we are still not that upbeat about, because the oversupply. It will take years, at least 3 to 5 years, especially for lower tier cities such as third tier, 4th cities, to digest to the inventory. And because of job losses caused by the tariff war, and also job security, people may not be as willing as in the past to buy properties. Okay, so real estate stocks, we think it will, but every time when there are news about bailout policies or relaxation on a property purchase, it may trigger a short-term rebound among property stocks. We can look at a few, for instance, Country Garden. You can see actually very low volatility on the stock, and the momentum was quite weak, except for early this year when there are news about relaxation of the restriction on property purchase. It had triggered the price, or also some I think they are still facing two headwinds. One headwind I mentioned just now is the inventory, oversupply of property. The other one is the debt default risk is not totally solved yet. If home sales remain slow, they may be still facing default or even going bankrupt risk. Okay. The tech stocks held under 3067. 3067. I'll need to check. Give me a few seconds. 3067. Let me check. 3067. I'll show you the chart. It's 3067. Is iShare Hang Seng Tech Index. Yes, this is iShare Hang Seng Tech Index ETF. It tracks the Hang Seng Tech Index, which comprises 30 Hong Kong listed companies in the technology sector or with tech-enabled business. So to answer your question, it is purely Hong Kong listed stocks. Okay, the top 10 or I name top 15 comprise Tencent, Alibaba, Meituan, Xiaomi, JD.com, Kuaishou, Li Auto, NetEase, Baidu, Trip.com, BYD, Sunny Optical Technology, Semiconductor SMIC, Bilibili, and Lenovo. So I hope I can have answered your question. Kindly recommend 2-3 high dividend ETFs for investment. Okay, this is one new ETF issued by Hang Seng, which I can also talk about it. This is high dividend ETF. One special features about it is it pays dividend every month. Okay, and the expected dividend is about around 8% at the moment. Okay, I will give you more details on this. It was listed last week. You can see, so the price chart the history is very short. Okay, give me a few seconds. Wait, So for investors who are eye on cash flow, because this ETF pays dividend every month, so it may fit those investors who expect cash flow dividend payment every month. They receive some payment from the ETF. Okay, it's managed by Hang Seng Asset Management Company and was listed last week. Yeah, this is the Hang Seng High Dividend 30 Index ETF, which tracks the Hang Seng High Dividend 30 Index, which includes 30 Hong Kong listed stocks with high dividend yields. Among those constituent stocks are HSBC, China Mobile, CK Hutchison, Sun Hung Kai Properties, CLP Holdings, the Hong Kong and China Gas, Hang Lung Properties, New World Development, Sinoland, Swire Pacific, Power Assets, MTR Corporation, Bank of China, Henderson Land, and China Resources. It focuses on sectors like utilities, real estate, financials, and telecommunications. which typically offer stable and high dividend payouts. I talked to the fund managers the other day, and they highlighted that this ETF doesn't have any exposure to any tech stocks. So it's only focused on sectors like utilities, Hong Kong real estate, and financials and telecommunications. So when tech stocks do well, it may underperform. This is one point I wish to point out. But when tech stocks like recently are very volatile, its share price, you can see, uh, uh, are relatively more stable. Okay. Mm, okay. How will Alibaba be affected by the tariffs? I think I've explained that quite carefully. Maybe you can watch the replay of this webinar on the part about Alibaba being affected by tariffs. In short, it's e-commerce, AliExpress, and its cloud business will be more directly affected by the tariffs. Okay, what is Baidu's current valuation, and what are their potential upside and downside risks? Let me check. Baidu, can you press for me? 9888. Okay. Baidu share price performance is quite disappointing in regard of its very early venture into AI and autonomous driving. Yet it's not reflected in the share price as well as the valuation. Um, Now it has a market cap of around 30 billion US dollars. Okay. The forward PE is quite low. It's trading at around 8 times forward PE compared to the industry average of 18 to 19 times. Baidu appears undervalued. Okay. But why is it undervalued? Maybe it's because it's the monetization. I think the main problem for Baidu is it has good start. It has good start. It is seen to be the early bird in AI, in developing AI as well as autonomous driving. Yet, being a early bird, it doesn't manage to eat the early worm. So it at up till now, it does not show very strong monetization capability regarding its AI and autonomous driving AD ventures. So I think that's reflected in the relatively low valuation. So unless it can show that its monetization accelerates, picks up, and also show better profitability. Otherwise, the valuation may remain at a subdued level like at the moment. Okay. My view on MTR. MTR, I'm quite neutral, or I have a cautious view because of a lot of its earnings are derived from the profit sharing of property development above its MTR stations. Okay. Uh, and now the Hong Kong property market is rather distressed because of oversupply. It's estimated that there's an oversupply of more than 60,000 units, unsold units in Hong Kong. And then the investment property held by shopping malls and office property held by MTR may also be vulnerable because of rising vacancy rate in Hong Kong. Office vacancy rate has risen to grade A offices has risen to about 16%. Wow. So those holding Hong Kong land may also need to be careful because of the rising vacancy rate among grade A offices in Hong Kong. Okay. And then in the next 3-4 years, it has to commit huge capital expenditure to develop new train routes in the next few years. Okay, so one of the downside is Hong Kong, the weak domestic Hong Kong economy with could slow retail and property leasing growth, impacting its rental income. As I mentioned just now, its exposure to shopping malls and also office properties. And then its capex, it has announced 100 billion Hong Kong dollar capex on rail projects. It may raise its gearing ratios and also undermine its ability to pay at a similar dividend payout as in the past. So these are the points, the highlights I wish to highlight. My view on MTR is I have a relatively cautious view on MTR. That checks performance on SSE and Shanghai and Shenzhen. SSE, you may choose the let me see, 30. Let me see. SSE is I forgot the stock code. Give me a few seconds. It should be 2A, starting with 2A, 2823, 2823, which tracks the is iShares FTSE China A50 ETF. This is for Shanghai more with more exposure to companies listed on the Asia market, but also include Guizhou Multi, China Merchants Bank, Ping An Insurance, ICBC, CATL, the battery manufacturer who is going to get listed in Hong Kong, BYD and China Yangtze Power, and Wu Liangyi, and China Life. Media is also among the top 10 holdings. The other one, Sunshine, you may take a look at the CSI 300 ETF, the 2846. 2846. Just now, Shanghai with exposure to Shanghai is 28223. This one is 2846, sorry, right? 2846. Yes, it's iShare CSI 300 ETF. Its constituent stocks more or less the same. Besides those stocks I mentioned just now, it also has high vision digital technology, which is engaged in surveillance technology. Okay, so these are the two ETFs for your reference. Okay, while the oil companies did not rise in first quarter in line with other Hong Kong Chinese stocks, if you look at the oil price, you will not be surprised why oil stocks are the Santong the 3 barrels of oil did not rise in Q1 because since early this year, oil prices are under pressure, and recently last overnight, the OPEC again uh, lower its demand growth forecast yesterday, projecting crude oil demand to grow by 1.3 million barrels per day this year, and next down by about 150,000 barrels from prior estimates. So oil prices will continue to be under pressure, which will also pressurize oil companies such as CNOOC and Sinopec. Among the three, oil companies in China, CNOOC is most sensitive to oil prices, so its share price underperformed. The other one is 386. So among the three oil companies, the one performs better. And if you are really keen on oil companies, our pick at the moment is PetroChina. Until when oil prices reverse the downtrend, then CNOOC may be better because it's more sensitive to oil prices. But before that happened, I think now the safer bet, more diversified one with upstream, midstream, and downstream. PetroChina is more, Sinopec is more on the downstream, and PetroChina is more diversified, more vertically integrated. So at the moment, we think 857 PetroChina is the best among the three oil companies. If you are keen on oil stocks, what's your view on JD.com and how they are? JD.com is actually in the more or less in the same position as Alibaba. Is e-commerce will be, but recently they are. Let me see. Its e-commerce will also be indirectly affected by the U.S. tariff war, as well as a slowing economy may also undermine domestic spending power. But recently has started an initiative to turn the export-oriented sales, shifting from export-oriented sales to domestic sales in China. And if this succeeds, I think it may help JD.com to divert some of the business back from export to domestic, but remains whether it's successful or not remains to be seen. JD.com. Okay. This one is the same question. What is your view on CK Infrastructure, Link REIT, and China Tower? Okay, one by one. CK Infrastructure, because Lee Ka-shing group of companies recently under pressure because of the the political risk, as you may have read in the news about its planned sale of its port business to BlackRock, but it is opposed by the Chinese government. So this uncertainty, you can see the whole group, family, yeah, compared to now, this is Hong Kong Electric. If you look at China Light, the share price is more resilient. Actually, it has not dropped much compared to power assets. Okay, and 1038. So we think this is a price discount tied to the political risk that Lee Ka-shing's group of companies are facing at the moment. If you are not mindful of the political risk, actually it's the valuation because of the price discount. It looks more attractive, but it may remain subdued because of this political unsolved political uncertainty stemming from this announced sale of its port business. Okay. Link REITs, Link REITs, I think is better than MTI to compare the two because its neighborhood shopping malls is more resilient to the economic cycles. Okay, it's more counter or counter cyclical. Okay, 823, I think it also see support around 50 dollars, the 250-day moving average. China Tower, I don't think it's an attractive um, bet because it's trading at 15 times PE. If you compare, when people ask me about China Tower, I will point to China Mobile, China Telecom. The three are trading below 10 times PE, while China Tower is trading at 15 times PE. And the dividend yield, China Tower is only paying offering 4%, 4 to 5%, whereas China Mobile is the dividend yield is uh, close to between 7 or 8%. So from a dividend yield perspective, as well as a um, valuation perspective, China Tower pales compared to China Mobile and China Telecom. And also China Mobile and China Telecom are the uh, main clients and also the major shareholders of China Tower. They will give business to China Tower, but they will control the profit margin. They will not let China Tower to uh, mean to uh, uh, expand the profit margin. So its profit margin will be under pressure, and in terms of valuation and dividend yield, I don't think it's as attractive as China Mobile and China Telecom. I would prefer China Mobile and China Telecom to China Tower. How China pharma company will be affected. Just now I mentioned those companies which are dealing in which are engaged in producing API and in ingredients and raw and intermediates will be more vulnerable to potential pharmaceutical tariffs to be announced by the US. But those companies who are engaged in research and development of innovative drugs, El Queso Innovate is should be less affected by the tariff war, okay, because of its involvement in innovative drugs. El Queso, the Queso. Let me El Queso, the stock code. I'm checking up the stock code of El Queso. To take a look at the share price. So Akeso's primary products are biologics, such as monoclonal and bispecific antibodies. It's not engaged in the production of API, so they are not typically subject to the same tariff categories or the or the tariffs targeting APIs and intermediates. Okay. Um, Another question: is NetEase affected by tariff? How much? Well, I think there's not very huge direct impact on NetEase because it's more in the domestic gaming market. Okay. Uh, 9999. Okay, so you can see the drop is quite moderate compared to other tech companies because of the less direct impact of tariff on the NetEase due to its business nature. It's primarily in a few business lines. Beside games, is music, NetEase Music, as well as education, online education, which are more domestic market oriented and less, actually, not so much US oriented. So it is the impact is quite minimal for NetEase. Hong Kong EX is not performing appropriately despite so many positive news like CATL going IPO, historic turnover possibility, delisted from US. Well, you need to look at the valuation. Now, I based on my observation, Hong Kong EX, the valuation, its historical PE band was in the last 10 years, it was trading between 25 times to 40 times PE is earnings. Okay, it's a historical PE band for the last 10 years. But during very exuberant bull market, it can trade up to about 40 times PE, up to 50 times PE. But what that was quite rare. Only during the peak of bull markets, you will see the kind of valuation, about 40 times. So last year, bear in mind, the earning per share for Hong Kong EX is 10.32 Hong Kong dollars. Just take a lump, round it up as $10. So at current price is 330 Hong Kong dollars. It translate into 33 times historical PE with earning per share, $10 earning per share earnings. Okay, so it's neither cheap or nor too expensive. So it's in the middle of its historical PE band. Okay, I think it is below 30 times. So like last week when its share price dropped to 280, around 283.2, I think there was a good opportunity to buy on dips because that represent and translate into a PE of 28 times, and the historical PE band is between 25 and 40 times. So going forward, I think my tips for you on 3AA is when the PE, historical PE drops below 30 times, it can be a buy, okay? And it rise above 30 times, close to 40 times, you can sell because it's already reaching the high end of the PE band. Like early this year, it rose to 380. That represents 38 times PE. It's quite easy to calculate the PE because now the earning per share last year was $10. And every year it saw a very gradual increase of around a high single digit rise in earnings per share. So you can estimate the forward PE as well. So if you sell at 380, buy back at 280, wow, you make 100 Hong Kong dollars just within less than 1 month, I think, close to 1 month period. So bear in mind, it's PE band between 25 to 40 times. Below 30 times, I think it's a buy. And then when close to 40 times, you may close your eye and sell, except when the Hong Kong market has entered a super bull market. Then we may see 40 times, 50 times PE, bringing its share price to $450, $500. But that may not happen in the near term. Okay. What's the access linkage in English? I think that's the link. The link, let me see. Um, show this. This one. No? Yeah, this is the linkage to our daily videos, which you can, if you have time, interested, you can take a look every morning. It will be uploaded on YouTube around between 9:30 to 9:45 in the morning. Okay, so maybe now it's approaching 2 p.m. Now I'll answer the last question. What are the other main semiconductor manufacturers in China? Where does SMIC stand in competition in China? Actually, SMIC is the largest and the most competitive semicon manufacturers in China. However, its products are mainly rather low end chips, 28 nanometer, between 48 and 28. Now it is able to produce. It's reported that it's able to produce 7 nano, but other leading companies such as TSMC and Samsung, they are already developing and producing 3 nano, 2 nano. So SMIC, technologically speaking, it lags behind Samsung and uh, TSMC. Okay, I'll show you the other one. 1347 NEC. Okay, NEC Semiconductor. This is another conductor company stock listed in Hong Kong besides SMIC. Okay, so I think I'll end the presentation here. I hope you find today's webinar useful, and I look forward to seeing you again in 3 months' time. Okay, thank you.
Thank you. Thank you again, Louis, for the presentation and the interactive Q&A. We have now come to the end of the webinar today, and we would like to thank all of you for joining. For the session just now, we will be uploading the recording on PhillipCapital's YouTube channel. You may view the recording of the webinar on your own time. Do take your time to fill in the survey so we can improve your experience with us in the future. You may scan the QR code or on the screen now. You may also join our investing communities to get free access to full research reports and discussion on technical analysis. Once again, thank you all for joining us today, and we hope to see you next quarter. Stay tuned, take care, and have a nice day.